So hi guys, my name is Yannick and I've been studying accounting for a few years now. I did my CPA exam a few months ago and I wanted to show you how our accountants look at financial statements. So I'll do it with Suncor Energy and hope you have fun. We can already see it's the first quarter of 2021, so from January to March. The figures are unaudited, so that means they weren't verified by outside sources, so outside accountant that are independent. Now, the information presented is in Canadian dollars, and we'll see later on what that means because there's gonna be a lot changes from USD to Canadian. The information is now provided in bullet points. First of all, that's gonna be your main page. So first point, we can see the funds from operations were increased to 2.1 billion compared to 1 billion last year in the same quarter. We always analyze 1 year apart. So we have a bit more information. I'll go look at inventory later on with you. Next point, operating earnings, I'll go check with you from 746 million compared to a net loss of 3.5 billion. I'll explain to you the 1.7 billion non-cash impairment and charges, which is gonna make the 3.5 million way less. Next, we have production. Now, it's really important for this industry that the production increases and the price of the barrel must go up so they can sell at a higher price and have a better margin. Next, we have a bit more information. We see the refinery marketing is over 15% of the industries. Let's see a few variations percentage. First, revenue up 1.1 billion from 1 year ago, 111%, which you want to see because you want more money to the company from more sales. That's gonna be $131 per share instead of $66. So that means every share makes $139, which is a lot better than what it was. There's an increase in earnings, so the big numbers that we saw, it's a difference of 4.3, so 123% from the 3.5 million. And we can now see that shareholders, every share, instead of losing $2.31, they now make 54 cents per share. We saw the increase in production, which is pretty good, and you'll see later because it's not the goal of the company to make better production or increase production. We'll see why it's so low. There was also share buybacks with 3.80 million. I'll explain to you why they made share buybacks and why they repaid $1.1 billion in debt, which was about 37% of short-term debt from last quarter. Let's see if last year's performance were aligned with the strategy they wanted. We can see a bit here about the strategy and what they want to do. For debt repayment, 1/3 share buybacks. Okay, that's for 2021. And we have page 5, strategy update. Debt reduction, share buyback, equity investment in Svante. They invested so they could get the technology and produce less CO2. So why is Suncor investing their money this way? And is that what shareholders want from their money? We can see that paying debt reduces interest paid each year from the debt, so shareholders can get better revenue per share. And Suncor is taking advantage of the low price to buy back shares. So that's an interesting strategy. Now that the price of the share is really low, you can buy them back and maybe sell them later at a higher price. And if you have a lower number of shares, it's gonna be better for your ratios like earnings per share, revenue per share. Now, I talked a bit about Svante. They invested to protect the environment, which is a bit of the strategy, and respecting regulations by emitting less CO2. Now, the cons about these investments are there are less money invested in infrastructure, technologies. So we saw the operations that were only up 6% from last year. It's not our goal to up operations, but still shareholders would want better operation and less money for publicity, acquisition, to expand in the market shares. So in conclusion, Suncor is telling us we are stable, we don't need to up operations, we are already big enough. So what we're gonna do is try to strengthen the balance sheets by repaying debt, buying back shares, owing less money, so there's gonna be less cost each years, and the company is gonna be more profitable for shareholders. Now, what shareholders want to see normally is production increase, revenue increase, lowering costs. Now, Suncor is targeting lowering costs. That's where they're at right now. They have a lot of production. They have a big revenue. So the best way for them to make money to their shareholders is to lower costs. So next, we're gonna look at operating earnings. That's the most important part for shareholders because that's the money they're making in the year or the quarter right now. And so last year they were in a loss, so that's real bad for shareholders. But this quarter, 1 year later, it's up by more than 100%. Now it's really fun to see in a graph like this. First, sales volumes and price margin are up. Now that's from the decline last year. So we can see that sales and margin are up by about 600 million. Now they're up that much because it's explained later on that the fuel demand was so low during COVID that nobody was buying fuel, nobody was going to work, transportation was down. And now that COVID is less impactful, we can see sales are back, price margins are back, more revenue from oil price that is up. So Suncor could sell at a higher price. Okay, so a bit of royalties down, but it's not that bad. Now, inventory valuation. I'll go real quick because that's the big part with sales. So we saw sales from COVID. I'll go with you real quick about a few accounting principles. So, inventory got depreciated last year because there was less demand and crude oil price were down. So that means the inventories and assets, they get depreciated. Suncor had to put in their financial statement that they over evaluated their assets. So in 2021, for example, they had 4 million assets. They had the depreciation of inventories of 446 million, which is the maximum value to regain. Crude oil price at the end of 2020 was 3.6 million. This year, there was an increase in valuation because of the higher demand and oil price went up. So accountants are saying, well, our assets are now regaining value. So what we're gonna do is increase the value from estimations. So plus 377 million this year, and now the ending oil price in their inventories would be about 3.9 million. Now, what's important to understand here is that last year it affected negatively the earnings, and this year it affected positively the earnings. So it looks like the company is doing better, but thing is, next year you won't see this augmentation. So next year we might expect only, if we keep everything stable, we might expect 746 minus 541, so around 200 million in revenues. If we go back, we can see 400 minus 300, there's still value to regain, they can't say we gained more than 456. That's a maximum value to regain. So if we have a maximum of 73 million, that means that next year's operating earnings will be way lower. So what do we expect next quarter? We saw that this quarter was really good. Now if sales continue to be stable or increase from less COVID-19 cases, that's going to be really good for shareholders and the price will go up. Now, we want revenue increase from oil price going up. We saw that the oil price was going up, so that's going to be higher revenue for Suncor because they're going to up their price. And they're going to lower the debt costs from interest, so that's really good. Revenue are gonna go up. The only bad point is less gain from assets. So if we expect the same quarter to happen, which is probably a good starting point, we can see that from 700 minus the asset valuation, let's say we get 200, maybe 300 from operating earnings. It's still really good, and it's still really good because that's a really conservative approach, and it's probably going to be higher. If the price goes down a bit, I would invest in Suncor just from that. So now, operating earnings reconciliation. That's the big numbers we saw. This year, we were at 746, and we saw minus 421. If we go back to page 3, minus 4031, 746, alright, that's where we are. But we saw these numbers up 800 and minus 3.5. So let's start from the bottom. We can see last year we had a lot of asset impairment and inventory write down. That's really bad. 2 billion down. You don't want to see this because it means there's a decline in forecast, for example crude oil, and a decrease in demand, so your assets are going down. It affects directly the earnings. So if you only lost 400 million in total, now you're gonna add 2 billion and you're gonna get 3.5 billion loss, and that's pretty reasonable. You're worth less, way less than what you were. And now this year we can see, now demand is going up, oil price is going up, so we don't need to have inventory to write down. We don't need asset impairment, and they can even get up in value, which will increase the net earnings later on. So that's real good. Now next is foreign exchange gain loss, US dollar denominated debt. Okay, I'll go real fast. Last year they lost 1 billion from it, and this year they gain about 181 million. So money conversion, real fast. We will see the exchange rate page 14 and 15 of the financial statement. For each Canadian dollar, you were getting 74 USD in 2020, and now you're getting 77 USD in 2021. That's a variation of 6%. So that means that there are gonna be a lot of changes because the financial statement is in Canadian dollars, and the majority of sales of Suncor is in USD, and their expenditures are in Canadian. So a higher Canadian dollar means a negative impact on profit because they're buying at a higher cost and selling at a lower cost. So you need to pay attention to that in the next quarters. Now, what we saw, the 1 billion debt, from the 1 billion that we saw, that was from debt. And Suncor has 65% of its debt in USD. If the Canadian dollar increases, it means the company needs to pay less in US dollar. So I did a few simple calculations like account payables. If clients owe you $100,000 from your sales, now in 2020 it's gonna be around 135,000 Canadian. and in 2021 it's gonna be only 126 Canadian dollars. That means you lose 6% on revenue. So that's why Canadian companies like higher USD because it's gonna up their revenue. Now, debt is the reverse. So if you owe 1 million in USD, it's gonna be in 2020, it's gonna be 1.3 million, and in 2021 it's gonna go down to 1.2 billion because the Canadian dollar is stronger, so you don't need to repay as much because the US dollar is worth less. So you're gonna save $85,000 in 1 year only because the US dollar is lower. So that's a gain in money. And if you don't repay your debt right now, you're gonna lose that gain. So that's why Suncor, instead of selling more and losing money, so instead of selling more and using their money to up sales, they're gonna pay back their debt, take the discount right now, and it's gonna be better in the long term because they're gonna have less money to owe. Now, exchange rates. Right now in this quarter, we can see it's 77 cents that we saw. It went up a lot. So in their earnings, so instead of 746 minus 126 plus 20 plus 181, it's gonna be 800. Now shareholders have more money. If the Canadian dollar continued to go up, it's gonna be beneficial for Suncor to pay back debt. So real fast, if there's no more depreciation from COVID-19, assets can regain their value, which will increase operating earnings. So what we need to see next quarter is less depreciation from COVID-19, so assets can regain their value, and for Suncor, because their revenue might get affected by the exchange rate, we don't want to see minus 1 billion. So the earnings will go up. So I have good expectations. Suncor's strategy is really good right now, and if you're a shareholder, you love this strategy, and it's a strong reason to invest in Suncor. So let's do a quick summary to end the video. Now we're only on page 6, but that's pretty much only financial information but more detailed. So you're gonna see net earnings from every, and you can look at it. There's some pretty good numbers, like that increase in oil sands from the demand. There was no transportation or barely during COVID, and now it's coming back, so that's good to see. Now you can go through really fast. Business environment, exchange rate, that's what I showed you, and it's more operating highlight. So what we're gonna do is go to page 44, where we're gonna see the statement. What we want to look at is first revenue up. We saw why it's up that much because of asset valuation gain. Sales are up, expenses are down by a lot. Now depreciation, impairment, that's what we saw. How much was it? It was 2 billion last year from impairment, so that's a big change this quarter. And financing expense, I'm pretty sure that's the 1.1 billion that we saw in exchange rate from the debt. So we can see in total there's a big change. Like instead of having expenses of 12 billion, now it's only 7.5 billion. And others, that's pretty complicated for this video to check this number, but let's make it real quick. Last year you had a loss, so no tax, so already that's a big number change, and maybe there was benefit plans that were going up. So second number that we saw, which was 3.2 billion in the summary, which was 3.2 billion lost last year, is now 1.4 billion income. So per each share, you get 54 cents instead of having a loss of $2.31. Here we have the assets. The company has still a good asset in cash. So even if they pay their debt, they're not paying back too much. They're still keeping money for operations. Short-term debt, we saw they repaid 1 billion. Long-term debt, they sold their old debt that was high interest and they bought more debt that had low interest, maybe to pay back the short-term debt. So for operating activities, now for the cash flows, that's really important for the shareholders because you now have your net earnings right here. You can see all the adjustments from depreciation, impairment. Those are not, Suncor doesn't give out money for it, so you have to adjust it in your cash flow. You can see also here foreign exchange. That's not money that goes out of the company, it's just we need to adjust it. So cash flow still good last year, 1.3 billion, but now it's 2.3 billion. So we can see that their cash flow was always really good. That means their cash flow was always really good, and that's good sign for the shareholders because they know the company can pay back their expenses, they can have cash in case of operations going poorly. And now investing activities, what we see here is Suncor invested way less money in infrastructures. Let's see, exploration expenditures, assets. Like that was their goal. Pay back debt and invest less in operations. So if we see in financing activities, they increased their short debt in 2020. They increased it, and now they lowered it by so much, and they repaid here. That means their expenditures were not investing in activities using their cash to pay back their debt and finance and their financing activities, which means they ended with 1.7 billion cash flow, which, and we can see their cash equivalents. We're gonna see in right here in their assets 1.7 billion. So that's it. We have a stable income, good future, no more depreciation from COVID, good oil price. So shareholders were really happy with these earnings. So the current stock price that we saw increased from 8%. So that means well deserved because they are achieving their strategy, still making a lot of money, good productions. Yeah, that was a really good quarter. So if you want to invest in Suncor, I would highly recommend it. If you think that COVID-19 cases will go down, oil price, if you think oil price will go up. If you like this video, please leave a like, and if you want some more videos like this, please consider subscribing. Bye bye.